begin tonight. First off, I want to thank my staff. And as Mike is going through those pictures, it takes a team to get all of this orchestrated. And our advisors are working in multiple locations. We obviously are serving a large population of people, and it just goes like clockwork. And in our industry, staff is often referred to as the back office. And I like to think of our staff as the front line. Because what they do and what they say every day makes a big difference in how we're perceived. So I really want to thank my staff. And again, it's every day. It's not just here tonight. It's every day that they do a phenomenal job. And tonight I want to, before I start, give a little insight into what I'll call maybe the background or the inner workings of 1015 Associates. We always introduce our advisors, and I thought it would be really nice in a gathering like this for you guys to have a little bit understanding of how we work together. And I don't think we talk about it enough, and I really think it's a unique structure, and obviously it's working well, so I think it should give some attention. Your advisors do an awful lot every week, and their week starts out every Monday morning. They get moi. We have an advisor meeting 8:30 a.m. every Monday morning. If you're in the Goshen office, it's in person. If you're going to be in an outside office, you need to be on location to call into that meeting 8:30 a.m. on Monday mornings. I use that time in order to update them on any changes that we've made to the portfolio, what's going on in the markets, things that I'm thinking about possibly changing in the accounts. And really the intent is that when they're out in the field all week long, no matter who you're meeting with from our organization, they are completely up to date and have accurate information about your investments. And so it's important to me as a portfolio manager to not go in an office and kind of do whatever I do and hope that everybody gets it. We want to make sure that the message is clear and concise and up to the moment. So 8:30 a.m. their day starts with me. They've got their meetings all week, and then they get to circle back, and on Friday afternoon, they get Mike and I. And on Friday afternoons, we'll cover when for doing any planning for meetings like this. But they are often assigned something that they have to do a presentation on. So they've got homework during the week in addition to what they're doing for you. And so if we add a new position, I will assign it to one of the advisors, and they are expected to do an in-depth research report on that company that has to be presented to their peers, the other advisors, and to Mike and I. It's kind of become this initiation process with our firm, and believe me, there's been some there's been lots of sweating, near tears, lots of anxiety in getting up and presenting to the owners of the company about a stock that we've chosen. I hope what we're doing is getting good results, and that when they're out there, they know what they're talking about. And that's the process that we use internally to make sure that all of you are getting the right experience. And 2017 was a major year of technology upgrade in addition to the new offices. And in addition to Evan and Andrew, Erica was integral in getting this new program laid out. We are beginning to trade on a new platform, and we will also be rolling out new reports this year. We love the reports we have. We think they do everything that they need to. But part of our mission is to make sure that every year we're trying to we're doing better and better at what we do for you. So you can expect that this year, that we'll be rolling out some new reports as well. So lots of new things happening at 1015 Associates. And just thought it's a great time when I have you all together to tell you a little bit about how we work together as a team. So I do have a lot of information to cover this evening as usual. So I will get into this evening's information. For those of you who are new, what we're going to do this evening, we're going to cover where we've been, where we currently are, and the things that we'll be looking for going forward into 2018. When we met last time, we talked about a Goldilocks economy. And we're going to start first we try to do a little bit of trivia in order to get your brains moving tonight. So we're going to start with an evolution of language. And we're going to talk about some words that have become obsolete in the last several years. For any of you word junkies out there, maybe you know what amyl is. It describes something in this picture. It is the icy casings on the leaves and the blades of grass that you see as the sun comes up in the morning. Not a word that I had ever heard before. How about groak? For any of you that share your home with a dog, you have probably been the subject of groaking. It is to stare longingly at someone who is eating in hopes that they will ask you to join them. Lunting. Sherlock Holmes was said to do a lot of lunting, walking while smoking a pipe. Maybe since people don't smoke pipes that often, the word's kind of gone away. And then, of course, there's now new words in our language that have kind of evolved. So let's see how we are at those. Plastiglomerate. I actually said it correctly. Corporation that recycles plastic items, a stone made of sediment and plastic, plastic trash that collects on beaches, or a nonprofit that cleans up polluted beaches. Any of you who guessed sediment rock? Kind of a sad state of affairs of how we take care of our land. How about sus? To blend one thing with another when something is suspect or sketchy, a genus of mammals comprised mostly of canines, or to suspend disbelief. Short for suspect. Great scene from It's a Wonderful Life. And last but not least, during the campaign, there was great debate. Is he saying big league or is he saying big Lee? And so does it mean in a big manner, in a forceful manner, in a successful manner, or in a showbiz manner? In a big manner. And so we can use that word actually to describe the market of 2017. The markets performed bigly. So we'll take use of that word for tonight. So let's talk about what actually happened last year. There's another all-time high, looks like another all-time high, and hey, it looks like another all-time high again. It was the year of records. During 2017, the Dow Jones Industrial Average closed at a new high 70 times. That's the best since the late 1800s. The S&P 500 closing 62 times at a new high did not meet the best, which was 77 times in 1995. But certainly a year that's going to go down in the record books. By the numbers. The S&P 500 closed the year up 19.5%. The Dow Jones Global Index ex-US up 24.5%. Emerging markets up 34%. Gold up 12%. REITs up 9%. The only sector down was commodities. When we look outside the United States, the numbers are even more striking. China up 50%, India up 35%, Brazil up 25%, and Europe up 18%. We are in the midst of a global market rally. In the United States, the markets here were definitely helped by earnings. When we came out of the financial crisis, we spent several years together talking about what was referred to as a Fed-driven rally, meaning Federal Reserve was doing everything in their power to stimulate the economy and therefore stimulate the markets. This is something completely different. Earnings for U.S. companies over the first 3 quarters of 2017, we're up 11.5% year over year. And I'll tell you even better than that, for 2018, earnings are expected to grow by 14.5% next year. Earnings recovery has come across many different sectors. That far, that's your left bar on the chart, that's the increase in earnings for the energy sector this year. I was talking to somebody earlier tonight. We were here in this location 2 years ago. 2 years ago, we were talking about a commodities meltdown around the world. Oil prices got as low as $27 a barrel. Ironically, energy was the best performing sector that year because investors looked forward that when oil prices rebounded, earnings would go up. Earnings alone don't necessarily equate to returns. It turns out that 2017, energy was one of 2 sectors that were negative last year. This scatter plot here shows us we got 2 sectors down. We had energy and telecom, only 2 losing sectors out there. Right up on top, 34% technology, followed by things like materials, financials, consumer discretionary, healthcare. When I look at that chart, and this is something I know I talked to my clients about and we discussed at length in those advisor meetings, this is a picture of a healthy and a rational market. Let me explain what I mean by that. I've been through markets in the past where the index goes up, but when you break down the pieces underneath it, you got 1 or 2 things working and most things are not. Throughout the entire year of 2017, we literally watched the returns roll from industry to industry of all different types of companies and businesses, all working well. 2 out of all those is not so bad. So this to me looks like a healthy and a rational stock market. The one thing that was missing last year, which none of us were certainly crying about, was volatility. This is what we call the VIX, the Volatility Index, or better known as the Fear Index. And we've talked about this in prior meetings. Prior to 2017, the VIX had only closed under 10 9 times in its history. It's averaged about 18. It spent the bulk of 2017 under 10 and never once traded at its average of 18. This is a phenomenon that a lot of people are talking about, but we certainly had absolutely no volatility for 2017. So investors were relatively complacent and they were extremely bullish. Right up into the end of the year, very end of December, 52% of investors polled were bullish. This is usually a concerning signal. The average is only 38. And we look at this very often as a contrarian indicator, meaning that if everybody's already bullish, that means the next move is likely that the market is going to go down. Throughout the entire year, people remained optimistic. They remained relatively complacent, and they remained extremely bullish. And what about that bear market in bonds? We have been talking, and the experts have been calling for a bear market in bonds for the last 4 years. The most recent call came out on January 9th. Bill Gates says, or Bill Gross says that we have officially entered a bear market in bonds. 10-year Treasury bonds last year closed essentially where they started the year. We started at yields of about 2.4%. We ended the year at about 2.4%. That doesn't seem to make a lot of sense when we're in a year that stock markets are rallying around the world, unemployment is at 4%, we had 2 quarters of back-to-back GDP growth of 3%, and you've got earnings growth, and yet long-term interest rates did not budge. That doesn't make sense unless you understand this. This is a map of the world. All of the areas that are in shades of red and pink, those are areas where central bankers are normalizing and beginning to tighten their monetary policy. All of those other big giant blue and light blue areas are areas of the world in which central bankers still have quantitative easing or are cutting interest rates. So when we came into 2017 and we talked about this midway through the year, that there is a structural interest rate problem, I guess you could call it, around the world. And we felt that because of this, even if rates were to go up, they would likely not move up a lot. And that was exactly the right call. And everybody was getting out of the bond market early last year, and we were adding to bonds, believing that yields were higher, but they weren't going to go much higher from there. Turned out to be the right thing to do. And again, think of it this way. Look, 2.4 isn't great, right? But you've got money from around the world that needs to find a home. And 2.4 is a whole lot better than they can get anywhere else. So it creates that demand. So one of the things that we saw out there. Our Federal Reserve is deploying 3 different mechanisms in order to raise rates in the United States. They are hiking. We got 3 Federal Reserve rate increases this year. They also are sellers of bonds. They're reducing their balance sheet. We talked several years ago about quantitative easing and that the Federal Reserve would be out there in the open market buying bonds. And as long as we had a buyer for our bonds, it would set prices and it would control interest rates. Well, now we got the Federal Reserve is selling bonds, and it can and it could become disruptive to the markets because now you have excess supply of bonds on the market. So they're raising rates, they're selling bonds, and they're also allowing securities to mature. So if something is to mature, they don't refinance it, they let it just come off the balance sheet. All of these things, although not doing anything to long-term interest rates, 2-year Treasury rates this year were up 58%. 2-year Treasuries this week traded at the highest levels that we've seen since prior to the financial crisis. Guess what? Higher short-term interest rates are giving us some great opportunities in short duration bonds. So as we see the interest rate curve change and where there's now some, I'll call it meat on the bones, that we can put some of your money to work with a good spread above 0% in your money markets, it's giving us some great opportunity in short-term interest rates. So where are we now? If you are a bear, this has been absolutely one of the most painful rallies for the last 14 months. This market just keeps going and going and going. And if you happen to read our newsletter at the end of the year that was titled "To Be Continued," and I don't take credit for the title, I write the content. It's my dynamic duo, Evan and Andrew. They're my grammatical and creative team. I'm not sure who's who yet, but I give it to them and they do that stuff. And so, but the "To Be Continued" was really on a theme that everything that we were seeing in the final quarter of 2017, to me, was a perfect setup to carry right on into 2018. Certainly didn't think it was going to be quite as strong as it has been, but certainly this is just continuing to run. What are investors going to start to worry about? Everybody's going to be talking about, to me, a few key things. Number one, the stock market's expensive, right? We're at all-time highs. It's expensive. One way of measuring stocks being expensive is what they call the CAPE ratio, which is a cyclically adjusted PE ratio. You don't really need to understand the details. What's important is where has it been before and where is it today, so what does it tell us? The CAPE ratio has averaged 16. It closed at 32. Obviously a lot higher than normal. It's not at its highest levels, but certainly elevated and will make investors begin to question how much they're paying for stocks. However, the analysts are quick to point out and tell us it also turns out that valuations are a really lousy market timing strategy. If you're concerned about what happens over the next 12 months, the amount of returns that can be explained by these ratios are basically close to zero. In other words, just because it's high, because 6 months ago when we got together, we used this chart too, it was high then also. It doesn't necessarily tell us where stocks are going to go in the next 6 months, but it's going to give people a lot to worry about because it's higher than normal. What about that correction? My goodness. Everybody's waiting for a correction. There's a lot of people that have been waiting for a correction since 2010 or 2011, and they missed this entire thing, or maybe they got out a year ago because the correction was going to come. As a matter of fact, we have had 13 corrections since 2009. A correction is defined by a move to the downside of at least 5%. We've had 13 of those. They've averaged a decline of 9%. They've lasted for 60 days, and the market has recovered those losses 55 days later. So what about a correction? Guess what? We're going to get one. I'm not smart enough to tell you when it's going to come. And I don't know how long it's going to last or how bad it's going to be. But if we were waiting for it a year or two, thinking that we shouldn't be in the market, we would have missed all that has been going on so far. Corrections are normal. They're part of the process. They're going to happen, and we need to be cautious of those things. But hey, the reality is, since 2009, we've been through 13 of them already. And many of you sitting in this room have been through them together with us. So, how do we predict corrections, and what's going to happen? A lot of big investment banks today are starting to recognize that a lot of these things are founded simply on investor psychology. Bank of America said a majority of the returns in the S&P 500 over the last several years can be accounted for by investor psychology, not any fundamentals at all. So this gentleman from Goldman Sachs says, if you told me 6 months from now that the market had sold off by 15%, I would say it was probably due to a shift in market psychology. So until we can figure out the psyche of people managing money out there, it's going to be pretty hard to predict when that next correction may come. What about inflation? This is going to be a huge topic in 2018. We've been waiting for inflation to return for quite some time. And if you look at the graph on the left, that's unemployment. Unemployment has come down around the world. Arguably, there are many economies today that are running at full employment. Inflation can be explained as the difference in what the economy has the ability to produce and what it's currently producing today. Arguably, that slack has been coming out of the economy pretty aggressively over the last several years. That should lead to inflation. The chart to the right, that very last tail in light blue, it's hard to see, that's the projection of where inflation is expected to go. But here again, in her last testimony, Federal Reserve Chair Janet Yellen said, "It's a mystery to me. has no idea why we're not seeing inflation. Just this past weekend, I was reading an article, and there's lots of theories about why we're not seeing inflation. And I want you guys to think about this. What about this disruptive world that we live in? Or at least that's what they call all these different technologies that are out there, disruptions. That you can buy anything that you used to buy, and now you can go on Amazon and get it for a fraction of the cost. What about traveling? Hotels, they've gotten real expensive. Oh, well, why would you bother with a hotel? Go and get Airbnb. Or you're going to take a taxi. Why would you spend that much when you can Uber? And, I'm really proud of myself, by the way. Mike and I were traveling last week, and we would normally take a taxi or car service. We used Uber. So we've really adopted technology. But here's the reality. The taxi or car service would have cost us $100. The Uber was $50. That's deflation, you guys. And it's in every part of our economy. The Fed is using its old models, looking at things we typically buy. They're waiting for inflation to recover, yet all of us have figured out that there's a whole society and technology that's allowing us to do half the things that we used to do an awful lot cheaper. So I don't know what that means to inflation and how will that factor in as we move forward. But there's everybody starting to wring their hands now about inflation returning. Barron's did a big article the last week in December about what will inflation mean to the stock market, because that's what we want to know, right? We don't care that there's inflation. How's it going to affect my portfolio? So what they did is they looked at all different periods of inflation. The first bar graph from negative to 2%, from 0 to 2%, 2 to 4, and so on. As inflation increased, the multiple that investors were willing to pay for their stocks decreased. Remember I talked about that multiple? Multiples are high right now. So if you've got low inflation and high multiples, if inflation starts to creep up and multiples come down, that's not good for stocks, right? Now, inflation is actually good for some stocks. Inflation is good for things like energy and materials. There's parts of the economy that will do very well for a period of time under an inflationary environment, and there's things that you don't want to own during an inflationary environment, such as utilities and staples and telecom. They don't have the growth rates that you want. So when I look at this and I think about managing your money, what if inflation really doesn't come back because of the disruptive economies that we have going on right now? And that the old models that everybody's following, you don't really see that bleed through of inflation, but in fact we continue to see earnings growth and our multiples remain elevated. That means stocks could continue to perform very well under those circumstances for a very good period of time. So, there's always two sides of every argument. So everybody's starting to focus on, oh my God, here comes inflation, and if inflation comes, that's going to be negative to our portfolios. This is a chart of interest rates. And that very, very back part shows the flattening. That red line is US interest rates. And you see that little flat part? That's 2017. Rates basically leveled off. We're higher than everybody else, but rates have kind of leveled off in all economies around the world. So again, we've been waiting for higher rates. We've been waiting for higher rates last year and the year before that, and so on and so on. And the reason that that is important, because all of these things are tied together. If the Federal Reserve expects higher inflation and they start to see inflation numbers tick up, they're going to raise rates more aggressively. They do that in order to slow down the economy. So if we assume inflation is coming back, we should assume that interest rates are going to go higher, right? Maybe inflation doesn't return. Maybe rates stay. Maybe this is a more normal environment for the type of economy that we live in today. So all these things get tied together, if A, then B, but we just don't know what that correlation is that's going to start the whole process going right now. And what about tax reform? This is the wild card. All the worrying in December, will they get it done? If they get it done, will it be big enough? Will it be bold enough? Is it already priced in? We had a miraculous rally in the last quarter of last year. Is it already priced in? And if it's priced in, how much of it is already priced in? Well, I think we understood some of the mechanics of tax reform. What we didn't understand is what we're getting today. We are seeing companies, we had 2 more companies announce it today. Disney and JP Morgan, raises and bonuses. This is money that is going directly into the pockets of people who are going to spend it. We're seeing across different industries and many companies. We've got companies that are announcing that they're increasing the match on their 401ks. That's not money to spend today, but boy, that's a lot of stress off me that I feel my future is going to be better taken care of because what my company is going to do for me. Apple, the first of the big giant tech companies, repatriating $255 billion that will cost them $38 billion in taxes. That is revenue our country would not have had. They are the first of likely many companies. The Cisco CEO was speaking today. They have to the tune, I think, of $155 billion or some crazy number like that. They will make their announcement during their earnings call. These were things that were not built in. These are the surprises that people are dealing with in the first part of 2018, which has set our markets off to a start that we have not seen in a really long time. So what do the economists think? When they poll the economists and they ask them, over the next decade, will this tax package substantially add to GDP? The consensus is, I don't know, most likely not. And then they were asked, in the next decade, will this tax package substantially increase the debt to GDP ratio, which is not a good thing, by the way? And their answer is, I don't know, but probably yes. So again, this is something that people are going to be worried about, what the economists are telling us. And again, I'll ask you this. In the world that we live in today, that moves, in my opinion, in warp speed, how much confidence do you have on a decade-long projection? I won't make decisions in your portfolio based on what these guys are saying 10 years from now. So we have to pay attention to it because it makes people worry about these things, that the economists are not too happy with the tax plan. As far as the S&P 500 are concerned, there is a direct correlation. Cut the corporate tax rate by 20%. Earnings on the S&P 500 will go from 141 to 151, and that's where we use that word multiple again. Now you assign that number a multiple. That means stock prices go higher. So that money that you take right out as far as taxes drops to the bottom line, increases earnings, therefore stocks should trade higher. Want to point out the very last part of this statement though. But a major risk for the market is the potential rise in US inflation, which could push the Federal Reserve to tighten more aggressively. So we're right back to the inflation and interest rates again. We like to think of all of this as moving through the business cycle. That there's periods throughout history that we move through a recovery, expansion, and then ultimately into recession. What's important about this is all the major economies around the world are somewhere in a period of recovery and expansion. There is not one economy today that is in recession or at risk of going in a recession at any time soon. What history tells us is that those first three parts of the chart there are that during periods of expansion, there's parts of the market that are going to work better than others. You want to own healthcare, you want to own technology, you want to own materials, you want to own financials, you want to own consumer discretionary. You want to own those things when the business cycle is on an upswing, and if, which we do not see right now, but if we start to see the headwinds of a recession in front of us, it's not a matter of being in the market or out of the market. Nobody's smart enough to know that. But it's a matter of a different complexion of your portfolio. Now maybe if we see a recession, you move more toward consumer staples. You have heavier weight to utilities, heavier weight to telecom. So those things work better if we start to see signs of a recession in front of us. So where may we be going from here? Is it freezing in here? Yes. And I'm talking, so I don't know who can maybe ask them to like turn it down a notch, because I'll just, if I'm cold, I'm always cold, but anyway, sorry. So we'll get somebody on the heat thing. So, all right, so where are we going from here? Certainly, we would have to anticipate that the waters might get a little bit rougher. 2017 is what I call a year of double dipping. That we had the ability for the market to go up, and we didn't have that anxiety of having to roll down a couple of times in order to get to the other side. So we certainly expect that maybe volatility will pick up a little bit here. But this is something I don't think gets enough attention in the press. Those are the growth expectations of all of the economies around the world. Notice once again, as I pointed out before, there's no negative signs. Growth is maybe not robust around the world, but it is certainly better than the opposite. And so when we look at this, it reminds us that we shouldn't necessarily only look here for opportunities. We should be looking for opportunities around the world in this type of market. When I showed you those emerging market performance numbers, when those things go over, when the emerging markets start to outperform the developed economies, that is usually not a couple of month phenomenon. That typically lasts for several years. So it's going to be important to us to make sure that some of these areas, you look at the growth in India, Cambodia, and Bangladesh, certainly growing at much faster pace than we are here in the United States. So we're going to be looking all over the world for where we should be looking for investment opportunities. China, often referred to as another wild card. China is expected to slow this year. However, it is expected to pick up again in 2019. China GDP numbers just came out last week, better than expected, great sigh of relief. That's good for a lot of different industries when we see China hanging in there. And again, if the market is a forward pricing mechanism and it's going to look forward, it's going to look to the fact that China is going to be growing again in 19, investors will make decisions based on looking forward growth. So, but something to keep an eye on for this year. Brexit. We had the shock waves in the market a year and a half ago when the Brexit vote happened. Since that time, everything is stabilized, but the reality of getting this done is becoming extremely difficult and very slow. It will likely take away growth from Europe, and that does stand out as a risk. Economists have estimated it could take as much as 2% growth away from Europe as a whole. Europe is not growing that quickly to begin with. It could threaten to put their economy into a recession. So certainly one more thing that we need to look at. So let's step back from the markets for a minute. Let's think about this world that we live in and what's going on out there in the real world. And I'll tell you, we are on the verge of a technology revolution in this country again. And you know, many of us think about this, that, oh, it's going to be 10 years from now or 20 years from now. And we're right there. And this is, the numbers up there are telling you how much data will need to be processed for an autonomous vehicle. And the 5G network is ready to be rolled out in the coming years. That technology will make things like autonomous vehicles possible. The technology is there, but we need to be able to process massive amount of data at speeds that were once considered unthinkable. Once the technology is available and you unleash it, you've got a whole new animal. Think about what our world would look like with driverless cars. And I don't think it's 20 years away any longer. It's probably a lot closer than most of us think. The Harvard Business Review did an article about autonomous vehicles and artificial intelligence. And they said artificial intelligence, its ability to change the way we live today, is not an understatement. And you look at just one industry like the automobile, we would no longer need streetlights. We would no longer need parking and parking garages. No more parking tickets, no more speeding tickets, no more auto insurance. It would change the insurance industry. It would change municipalities. It would change industries. It would change jobs. What if those cars are powered a majority by electric? It would change the energy industry as well. This is just a scratch of the surface. And, you know, the age I am, I think of the Jetsons. And, right? Jetsons are right in our near future. And so, you know, you think this is crazy, but, I mean, I'm pretty old. But we didn't have cell phones in college. We didn't have laptops. We didn't have any of that stuff. And I'm not that old. I'm just old. So to think about what our children and grandchildren, what our world is going to look like, look, guys, this is going to be, there's going to be challenges, but you know what, it's going to be great opportunities as well. So I can't close a discussion of 2017 and not bring up Bitcoin. You all want to hear about this, right? Well, I'm not going to tell you what it's worth. I'm not going to tell you what I think it's worth. I don't spend any time thinking about that. But Bitcoin is essentially cryptocurrency that has morphed from technology called blockchain. Blockchain is a technology which allows transactions to happen where both parties are completely anonymous. And when we live in the society that we do, with our data being breached at every level we can think of, from every entity that you can deal with, the technology of blockchain is designed in order to be able to protect your personal data. So I don't know if Bitcoin will even exist a year from now or what it will be worth, but the technology behind it, I'm pretty sure, is here to stay. And that's something we need to understand as far as the blockchain technology. So what do we need to worry about? What are the things out there that we have to be thinking about? Well, there's risk of higher inflation. We talked about what inflation could mean to the markets. If the European central banks were to start tightening, which would risk slowing down their economy, would certainly pose a risk to the overall economies. An equity correction, higher volatility. What if Bitcoin were to crash? Maybe that would change investor psychology. And we learned what could happen if we change psychology. So something as simple as Bitcoin, although I don't think it's relevant to the economy, could cause problems for stocks. A bigger positive impact from tax reform than anticipated. Well, bigger, that's great, right? But we learned about too much of any good thing is not a good thing. We don't want things to get too good here. So we got to watch how that plays itself out. We talked about Brexit, higher commodity prices. I talked earlier about 2 years oil being at 27. We're all the way back now, close to 70. We don't want $100 a barrel oil again, do we? We've been enjoying $2.50 at the pumps for a really long time, and it feels pretty darn good. So too high on commodity prices would certainly be a drag to the economy as well. So that's something that we got to watch for. And so how do the analysts feel about all this? History suggests that some of the best returns come at the end of a bull market, with valuations and sentiment as high as they are amid relative economic calm. Despite political turmoil, we view a pullback in the market next year as an expected norm, and for well-positioned investors, a good buying opportunity. And then from Goldman Sachs, the current equity market valuation is certainly stretched in historical terms, but it does not appear unreasonable based on a high level of corporate profitability, those corporate earnings we were talking about. An earnings-driven bull market is inherently rational for a fundamental equity investor. And out of the team at Charles Schwab, a better than expected 2017 appears to be morphing into a solid start to 2018, but is unlikely to be a smooth ride. We believe the bull market still has room to run, but could shape up to be a bumpier ride as expectations and sentiment are elevated. So certainly some skepticism, but overall, most of the analysts feel the market is pretty positive. I'm a very visual learner, and I found this chart that I thought is really relevant. Our bull market is now 8 years old. Fortunately, the bull market doesn't know that, but investors know that. And so everybody thinks, you know, it's long in the tooth, that it's got to end just because of the fact it's 8 years old. Well, that black, dark black line in the middle, that's the rally we're in right now. Those other lines that keep on going, those are other rallies previous to this one that have continued on for several more years into the future. We're not necessarily at the end of this. History doesn't tell us that this is it, this is over. We have been through periods of time in this country that due to the circumstances that the market can continue to go up even beyond when people expect it to continue to go up. So in summary, we are definitely off to an amazing start. This is one of the best starts to the market in history. And there's lots of things going on behind it that are extremely positive. Even announcement today of several mergers. We've had the highest numbers, there have been $100 million of deals so far this year. We're not even done with the first month. So all these things are very positive. There are, and there always will be, things for us to worry about. It is my job as your portfolio manager to, number one, remain objective. There are things that are going on around there out in this world that make me unhappy, make me uncomfortable. There are things that I don't necessarily like, but my job is to understand how they impact the market. So how will they affect your portfolio? So we need to remain objective, pay attention to the fundamentals, and delineate between headline risks, things that we have to listen to in this news every day, between those headline risks versus real financial risks. It's not a perfect science, but it's our job to make sure we distinguish between the two of those. And I will tell you this. I don't remember a time in recent history that the economic backdrop lined up quite so well as it does right now with investor sentiment. It doesn't mean this will last forever, but I'm certainly not convinced that it's over yet. I don't know where we are, but I still believe there are several innings left in this game. It doesn't mean it's going to be smooth. Trees don't grow to the sky. There will be corrections along the way, but from everything that we're seeing, there is reason to believe the economy is continuing to get better and the market can continue to go higher. And remember, surprises can be positive. You know, we are waiting for another shoe to drop. It's just how we've been trained for the last decade. What's going to go wrong? And each day we wake up and guess what? There's actually something good happening. And, you know, so maybe we need to train ourselves a little bit better to think about, you know, the fact that surprises can in fact be positive. So, as usual, that's the end of my regular program. But I do want to share a video with you tonight, as usual. And one of the things that I have found so interesting in doing this for as long as I have, and having been through all different types of markets, you, our clients, we as human beings, we worry when the market's going down. And that makes complete sense, right? Well, guess what? We also worry when the market's going up, because we worry about when it's going to go back down. So I find it just, you know, sometimes so distressing that none of us, in general, really takes the time to stop and smell the roses. Why can't we just enjoy what we have and live in the moment and just drink this in for a little while and be happy about what's going on around us? And sometimes I think we need to kind of stop and just redirect our thoughts about how we think about life and what we want to do with each day. And so I found this video, and it made me think about that. What do I need to really worry about, and what should I really be thinking about? So I hope it kind of gives you the same thoughts that I did. So I want to thank you for this evening. I hope you enjoyed the presentation, and I hope that you really walk away from this and feel a little bit better.
These are roughly 28,835 jelly beans. I counted out 500 of them and used those to weigh the rest. In this pile, there's one jelly bean for each day that the average American will live. You might have more beans in your life, or maybe less, but on average, this is the time we have. Here's a single bean. It's your very first day. A special day, but kind of a rough day on everyone involved. Add 364 more and you have the first year of your life. Now, for a sense of scale, here are your first 15 years, 5,475 days, which brings us to the threshold of adulthood, and at that moment, this is the time that we have left. And this is, on average, what we will do with all that time. We will be asleep for a total of 8,477 days. If we're lucky, some of that time we'll be sleeping next to someone we love. We will be in the process of eating, drinking, or preparing food for 1,635 days. We'll be at work, hopefully doing something satisfying, for the equivalent of 3,202 of those days. 1,099 days will be spent commuting or traveling from one place to another, maybe a little bit more if you live in LA. On average, we will watch television in one form or another for a total of 2,676 days. Household activities, like chores and tending to our pets and shopping, will take another 1,576 days. And we will care for the needs and well-being of others, our friends and family, for 564 days. We'll spend 671 days bathing, grooming, and doing all other bathroom-related activities, and another 720 days will go to community activities, like religious and civic duties, charities, and taking classes. After we remove all those beans, this is what remains. This is the time that we have left. Time for laughing, swimming, making art, going on hikes, text messages, reading, checking Facebook, playing softball, maybe even teaching yourself how to play the guitar. So what are you going to do with this time? How much of it do you think you've already used up? If you only had half of it, what would you do differently? What about half of that? How much time have you already spent worrying instead of doing something that you love? What if you just had one more day? What are you going to do today?